All right, welcome second-year accounting students to this masterclass explainer. Go ahead and grab your notepads, get comfortable because today we're totally breaking down cost behavior and cost assignment to get you absolutely exam ready. We are going to take these somewhat dry accounting concepts and make them practical, make them visual, and most importantly, super easy to remember. So, here is our roadmap for today. 1. Foundations of costing. 2. Cost behavior and high-low. 3. IAS 2 and allocations. 4. Calculating OAR. And finally, 5. Recovery and a quick recap. Starting right off with Section 1, Foundations of Costing, naming the costs. Okay, so a cost object is, well, it's exactly what it sounds like. It is simply anything for which you want a separate measurement of costs. Let's make this real for a second. Imagine you are manufacturing wooden braille tables. If you want to know exactly how much producing one single table actually costs your business, well, that single table is your cost object. Literally everything we do from here on out is just an attempt to figure out the true, accurate cost of that object. Now, to find that total cost, we have to split our expenses into two main buckets, direct and indirect. Direct costs are the easy ones, right? They can be physically traced directly right to the cost object. So the wood, the steel, the specific carpentry labor needed to build that bride table, those are direct costs. But indirect costs, which we usually call overheads, are a lot trickier. Think about your factory's electricity bill or the factory rent. You absolutely cannot trace exactly how much of that rent goes into one specific bride table. So because these indirect costs support the whole business, they have to be allocated. Moving on to Section 2, Cost Behavior and High-Low, Understanding the Patterns. There are 4 main cost behaviors, and I want you to really picture these graphical patterns in your mind. First, variable costs. Mentally draw a straight diagonal line starting right from the bottom left origin. As you make more units, the total cost goes up proportionally, but your cost per unit stays exactly the same. Second, fixed costs. Just picture a totally flat, horizontal line. Your factory rent stays the same whether you make one single table or 1,000 of them. Third, we have step fixed costs. This looks exactly like a staircase. It's fixed for a certain band of activity, but say you expand too much, boom, you need to rent a whole new warehouse and your cost steps up. And finally, semi-variable costs. This graph starts halfway up the y-axis with a fixed base, and then it slopes upward based on usage, just like a variable cost. Now, semi-variable costs are a massive headache for accountants because they mix fixed and variable elements together into one big mess. Let's look at a local Boer-Wars factory to see how we actually solve this. We've got their production volume and electricity bill for several months. Electricity is classic semi-variable. To split this mixed cost into its fixed and variable parts, we use what's called the high-low method. The golden rule here is simple. You pull only the extreme highest and lowest activity months. So for us, that's January at 800 sausages and June at 1,100 sausages. Literally ignore the other months entirely. Just cross them out. All right, let's walk through the math step by step. Step 1. Find the variable rate. We subtract January's low cost from June's high cost. That's our 8,550 minus our 6,900, giving us a difference of our 1,650. Now divide that by the difference in our volume, which is 300 sausages. Our 1,650 divided by 300 equals our 5.50. And there you go, that is your variable cost per sausage. Step 2. Find the fixed cost. Take June's total cost of our 8,550 and just back out the variable portion. The variable portion is 1,100 sausages times our 550, which gives us our 6,050. Subtract that from the total, and it leaves us with a flat fixed cost of our 2,500. Finally, step 3, build your equation. Total cost y equals our 2,500 fixed cost plus our 5.50 variable times x. And just like that, you've mastered the high-low method. Which brings us to Section 3, IAS 2 and allocations, the rules of the game. Now, the International Accounting Standard 2, or IAS 2, draws a really strict line between product costs and period costs. Product costs are exclusively your manufacturing costs, direct materials, direct labor, and manufacturing overheads. Under the IAS 2 rule, these costs physically attach to the inventory sitting on your balance sheet. They only become an expense when that item is actually sold to a customer. Period costs, on the flip side, are non-manufacturing overheads. Think marketing campaigns or head office admin. These do not touch your inventory at all. They are expensed immediately straight onto the income statement in the period they occur.
So, you might be wondering, how do we actually get those valid manufacturing overheads into our product cost? Well, we use a two-stage allocation process. Step 1A is primary allocation. This is where we take all the factory overheads, like rent, and assign them across every single department in the factory based on some kind of logic, like floor space. But here's the catch. Some departments, like say the maintenance team, are service centers. They aren't actually building the product, and that brings us to step 1B, secondary reallocation. We basically have to empty out all the costs from those service centers and reallocate them straight into the main production centers. Why? Because the final product has to absorb the full cost of running the entire factory, not just the assembly line.
Moving to Section 4, calculating OAR, attaching the overheads. So the absolutely crucial point here is how we actually attach those accumulated departmental overheads to our cost object. You basically have two choices, a blanket rate or a departmental rate. A blanket rate is just one single overhead rate applied across the entire factory. It assumes, rather blindly, that every single product uses all departments equally. This is super dangerous and honestly often wildly inaccurate. A departmental rate is far, far better. It creates separate rates for specific production departments. This is absolutely vital if, for instance, your cutting department is heavily automated and machine-intensive, but your assembly department is mostly just manual labor. To actually calculate these rates, we use the predetermined overhead allocation rate, or OAR. OAR simply equals your budgeted overhead costs divided by your budgeted activity level. Notice I keep saying the word budgeted. Never, ever use actual figures here. Why? Because product costing happens throughout the whole year, way before the actual electricity or rent bills even arrive in the mail. We have to estimate. We divide the budgeted money by a budgeted activity base, like machine hours or labor hours, to get our rate.
Let's look at a numerical example straight from the source notes. Let's say after doing our secondary allocations, we have total budgeted overheads for 3 production departments, X, Y, and Z. We take Department X's overhead of R58008 and divide it by its specific activity base, which is 2,000 machine hours. That gives us a really precise departmental OAR of R29.00 per machine hour. We just repeat that exact same logic for Y and Z, giving us unique, accurate rates for each department based on what actually drives their specific costs. Now for the fun part. We finally get to attach these overheads to a specific product. Let's say a single product spends 2 hours in Department X, 2 hours in Department Y, and 1 hour in Department Z. You simply multiply those hours by our new departmental OARs and add them all up. So, R29 times 2, plus our 53.02 times 2, plus our 82.03 times 1, and boom, R246. That is the total overhead absorbed into that single product's cost. We did it! All right, final section. Section 5, recovery and recap, squaring the books. At the end of the year, our nice, neat budgeted estimates will inevitably clash with the actual, messy bills we receive. So we have to square the books. We do this by comparing the overhead we absorbed into our products against the actual overhead we incurred. If you absorbed less overhead than you actually spent, well, that's an under-recovery. You didn't charge your products enough. This shortfall becomes an additional period expense on your income statement. Conversely, if you absorbed more than you actually spent, that is an over-recovery. You essentially overcharged your products, and you actually get to reduce your expenses. Okay, key formula recap, the 60-second exam cheat sheet. Grab your phones, take a screenshot of these next few, because we are doing a rapid-fire recap of the absolute key formulas you need to memorize. Ready? Let's go. First up, the high-low method. Your variable rate equals your maximum cost minus your minimum cost divided by your maximum volume minus your minimum volume. And remember, please use only the extreme highest and lowest activity volumes to establish those data points. Do not just pick the highest rand value by mistake. Next, the OAR. Your overhead allocation rate equals budgeted overheads divided by your budgeted activity level. This is the formula that brilliantly illustrates that pricing requires forecasting. You absolutely must use budgeted data to calculate this rate at the start of the year. And finally, absorbed overheads. This equals your predetermined OAR multiplied by the actual activity level achieved. You compare this absorbed figure directly against your actual incurred overheads at year-end to find your final under or over recovery variance. And honestly, this right here is exactly why this topic matters so much. Mastering cost behavior isn't just about scraping a pass on your second-year accounting exam. Think about it. If arbitrary blanket rates risk completely mispricing your products,
Could a future business you advise be losing money on every single sale without management even knowing? Costing is the exact tool that decides if a business thrives or goes bankrupt. So keep questioning those numbers, students. Best of luck with your studies, and I will see you all in the next explainer.